requirements of MFRS 18, which requires the company to classify income and expenses into operating, investing, and financing categories in the statement of profit or loss, and plus income taxes and discontinued operations. And as a result, the two deals define subtotals, i.e. the operating profit and profit before financing and income tax are required on the statement of profit or loss. However, the subtotals will vary for companies with specified main business activities, either investing in particular types of assets or providing financing to customers. Let's come to the first category, i.e. the operating category. And the subtotal for operating profit provides a complete picture of a company's operations. Investors use the operating profit subtotal as a measure of how a company is performing in its business activities and as a starting point for forecasting future cash flows. The operating category is the default category, as all income and expenses not classified within the other four categories are included in this category. Operating category includes all income and expenses arising from a company's operations, whether volatile, unusual, recurring or non-recurring from main or other business activities. The investing category enables investors to analyze returns from standalone investments separately from a company's operations. Those are income and expenses from unconsolidated subsidiaries, associates, and JVs. Cash and cash equivalents, assets that generate a return individually and largely independent of all other resources held by a company. For example, rental income and the remeasurements of investment property, interest income, and fair value changes on financial assets such as debt securities, and as well as the dividends from shares in other companies. When we come to the financing category and the subtotal for profit before financing and income taxes, that enables investors to analyze companies' performance before the effects of its financing, and this includes income and expenses on liabilities that arise from transactions that involve only the raising of finance, such as bank loans and bonds, and interest expense and effects of changes in interest rates on other liabilities such as lease and defined benefit pension liabilities. MFRS 18 also has specific requirements on classification of certain items in the statement of profit or loss, such as classification of foreign exchange differences and the gain or loss on the net monetary position. And foreign exchange differences are classified in the same category of the statement of profit or loss as the income and expenses from the items that gave rise to the foreign exchange differences. Just take example, foreign exchange differences on bank loans are classified in the financing category, whereas foreign exchange differences on foreign denominated receivables for goods and services will be classified in the operating category. And in paragraph B68 of the standard, it provided an exemption that says if classifying foreign exchange differences this way would involve undue cost or effort, a company is permitted to classify the differences in the operating category for each item that give rise to the foreign exchange differences. MFRS 18 also includes specific requirements for classifying fair value gains and losses on derivatives and hedging instruments, and for classifying income and expenses from hybrid contracts. Question may arise on whether additional subtotals can be presented in the statement of profit or loss. The answer is yes, if it is necessary to provide a useful structured summary of the company's income and expenses. The company has to ensure that the additional subtotals comply with the requirements in paragraph 624 of MFRS 18. Let's come to the requirements of MFRS 18 for specific companies. And this here you refers to companies that are having main activities such as the investing in particular types of assets that generate a return individually and largely independently of other resources, and as well as companies that provide financing to customers. And these companies include investment entities defined by MFRS 10, and you may have investment property companies, banks, and insurers. And these companies will include income and expenses in their operating profit that for other companies will be included in the investing and financing category. As operating income and expenses are determined based on the operations of the company, the determination of main business activities is important. So the standard explains that a main business activity is a matter of fact and not merely an assertion by the company, and the entity shall use judgment to assess this fact, and this fact shall be based on observable evidence to the extent available, and which shall be assessed for reporting entity as a whole. So the investment, the assessment of main business activity by a reporting entity that is a consolidated group and a reporting entity that is a subsidiary in a consolidated group could have different outcomes. Companies invest in particular types of assets as a main business activity. Income and expenses from assets that generate a return individually and largely independently of the company's other resources, and the unconsolidated investment in subsidiaries, associates, and JVs not accounted for using equity method shall be classified in operating category. However, income and expenses from unconsolidated subsidiaries, associates, and JVs accounted for using the equity method are classified in investing category. Here is an example of statement of profit or loss presented by an insurer that typically invests in particular assets as a main business activity. As you can see, the income and expenses from its investment activities are classified in the operating category, whilst its share of results of associates and JVs are classified in the investing category. Whereas for companies providing financing to customers as a main business activity, income and expenses from liabilities arising from transactions that involve only the raising of finance related to providing finance to customers have to be classified in the operating category. However, the company has an accounting choice for income and expenses arising from raising of finance other than those related to providing finance to customers. As for income and expenses from other liabilities, they remain in financing category. Here is an illustrative example of the statement of profit or loss presented by a bank that provides financing to customers and investing in particular assets as a main business activities. The example shows that interest expense arising from raising of finance by the bank are classified in the operating category instead of financing category. Furthermore, there is no subtotal for profit before financing and income tax, as both investing and financing category are included in a single category.